Welcome back to the deep dive. Today, we're getting into the weeds with Ujjivan Small Finance Bank, or USFB. We've got their latest investor presentation, the financials for Q2 and the first half of FY26.
Yeah, and we're not just reading the headlines here. The real mission is to figure out how well they're actually executing their big strategy shift, moving away from pure microfinance.
Exactly. How real is that diversification? And is this recent profit bounce back sustainable?
Because, the numbers look good on the surface, profits up, growth seems strong.
But for you listening, the key question is this recovery built on a solid foundation? Especially considering that push into secured loans versus the, let's say, lingering stress in their older business.
Right. Let's dig into the actual data and see what's really going on under the hood.
Okay, first up, the financials. How did they actually perform in the quarter?
Well, the headline profit number, P net profit after tax, came in at 122 crore.
122 crore. And compared to the previous quarter,
That's an 18.2% jump sequentially, from about 103 crore in Q1. So a decent improvement there.
okay, but profit can be flattered by lots of things. What about the core operational earnings before provisions?
Good point. That's the PPOP, pre-provision operating profit. That also grew 9.6% quarter on quarter to 395 crore, shows the basic banking engine is running better.
Right. But the metric I was really watching, the one that felt crucial, was net interest income, NII. How did that look?
That's the one. It grew 7.7% sequentially, hitting 922 crore.
And why is that so significant?
Because, the sources point out this reversed a trend. NII had been kind of flat or even slightly down for the previous 3 quarters.
Ah, okay. So the core income generation from lending is picking up steam again, finally overpowering maybe higher funding costs.
Seems like it. It suggests that the loan growth momentum is starting to win out.
Still, looking at the returns, return on assets, ROA, was 1.0%. Return on equity, ROE, 7.7%. Those feel a bit, well, low, especially with the growth story we're about to tell.
They're not exactly stellar right now. But I think the direction is what matters here. When you're in the middle of such a big strategic shift and dealing with past issues, returns often get suppressed short term.
So the factor ticking up, even slowly, is the positive sign.
Exactly. It suggests the new, hopefully more stable asset mix is starting to contribute, even with cautious provisioning still in place.
Okay. And talking about costs, funding costs have been a headache everywhere. How did USFB manage?
Surprisingly well, actually. Their cost of funds, CUF, actually dropped. Went from 7.6% in Q1 down to 7.3% in Q2.
Really? A 23 basis point drop. How?
Yeah, management was pretty clear on this. They said they proactively reset rates on term deposits and savings accounts and also absorbed some excess liquidity. It wasn't just passive. They were actively managing it.
That's smart. Shows good treasury management.
Definitely. And it feeds into their overall deposit strength.
Let's talk deposits then. How's the liability side holding up?
Pretty strong. Total deposits hit 39,211 crore. That's up over 15% year on year.
And the crucial part, CASA, the cheap stuff.
That's the real win, I think. CASA current accounts, savings accounts crossed 10,000 crore for the first time ever. Landed at almost 10,800 crore.
Wow. And what does that do to the CASA ratio?
Pushed it up to 27.5%, which is, quite healthy.
And retail deposits overall, still sticky?
Seems so. Retail TDs plus that CASA make up about 71% of their total deposits. That's a good, stable funding base.
Okay, so they've managed the cost side, built a decent deposit base. That gives them the fuel for the other side, right? The loan growth?
Precisely. That stable, relatively cheaper funding is what allows the aggressive moves on the asset side. And yeah, the growth numbers there are pretty eye-opening.
Highest ever disbursements, the report said.
Yeah, 7,932 crore in just Q2. That's up nearly 48% year on year. Huge jump.
And the total loan book?
Gross loan book, or GLB, reached almost 34,600 crore, up 14% year on year. But here's the kicker, the number that really tells the story of their strategy.
The secured versus unsecured mix.
Exactly. The share of their secured loan book hit 46.8% of the total.
46.8%. Wow. What was it a year ago?
Just 34.9%.
So in 12 months, they've shifted the balance that dramatically, from about a third secured to nearly half.
Yep. It's a fundamental change in the nature of the bank's assets. They're rapidly approaching that 50% mark.
And why is hitting 50% secured such a big deal psychologically or strategically?
Well, secured loans generally carry a lower risk, right? You've got collateral. Hitting 50% signals a major de-risking. It makes the bank less vulnerable to the kind of shocks that can really hit an unsecured microfinance book hard. It suggests, more stability, more resilience.
Okay. And if we break down where that secured growth is coming from, are there specific products leading the charge?
Oh, absolutely. They highlighted a few superstars, as you might call them.
Like what?
Micro mortgages. That book grew 180% year over year.
180%. So nearly tripled in a year.
Yeah, it's now over 1,000 crore rupees on its own.
Incredible. Any others?
Gold loans. This is newer for them, but the growth was 6x, 565% year-over-year growth, now over 400 crore.
6 times. Okay. That's explosive.
And MSME loans grew 69% year-over-year, another strong performer. Plus, their big existing secured book, Affordable Housing Loans, AHL, they grew 42% year-over-year.
So it's broad-based growth within secured, but some segments are just stratospheric.
Right. And on the housing loans, they noted 94% were for self-occupied homes, which generally implies a safer customer profile.
Okay, but let's pause on that growth. 180%, 565%. That sounds great for the top line, but doesn't that kind of speed create operational risks? Scaling up that fast must be challenging.
Absolutely it does. That's the critical question, isn't it? Can they maintain underwriting discipline? Can they train staff fast enough? Can they manage collections effectively in these, frankly, newer segments for them at this scale?
So they've proven they can sell these loans quickly.
Right. But the proof of the pudding will be the asset quality in these fast-growing secured books over the next, say, year or two. That's what we need to watch.
Which leads us perfectly into asset quality overall. How did the NPA numbers look this quarter?
Headline numbers improved. Gross NPA came down to 2.45%, and net NPA fell to 0.67%. Both better sequentially.
Okay, that's positive, but NPAs are a lagging indicator. What about the flow of new bad loans? Slippages?
That's where we saw a really encouraging sign. Slippages dropped quite sharply to 278 crore in Q2.
And they had been running higher before.
Yeah, consistently around 350 crore for the previous 3 quarters. So seeing that number drop meaningfully suggests the inflow of new stress is actually slowing down.
And what about the early warning signs, the SMA accounts?
Also improved. Overall SMA, special mention accounts, dropped below 2%. It was 1.99%, apparently the lowest since Q1 of FY25.
Okay, explain that for the listener. Why is a drop in SMA important?
SMA is like the watch list. These are loans showing early stress, maybe 30, 90 days overdue, but not yet classified as NPA. When that pool shrinks, it's usually a good sign that future NPAs might also reduce because they're catching problems earlier or fewer problems are emerging.
And this improvement, is it across the board or mainly in certain segments?
Well, the core microfinance book seems to be stabilizing. Collection efficiency there, for the main group and individual loans, held steady at a strong 99.5%.
But didn't management mention some specific regional issues persisting?
They did, yes. They flagged that while the overall MFI portfolio is better, some states are still lagging. Specifically mentioned Karnataka and Gujarat.
Karnataka, for example. What was the issue there?
They quoted a PR 90-plus figure loans, overdue more than 90 days of 6.9% in Karnataka. They linked it to external factors, like a state ordinance impacting collections.
An ordinance. How does that directly affect loan recovery? Sounds a bit like an excuse.
Well, it could be a real hurdle. If local rules restrict how or when banks can contact borrowers or take recovery actions, it genuinely slows things down. It means their standard collection playbook might not work as effectively. They did say they expect Gujarat might take another quarter or two to normalize fully.
Okay, so some localized pain points remain. But is there evidence they're getting smarter about risk overall? They mentioned MFIN guardrails.
Yes, and this was a really striking data point, I thought. MFIN is the industry body, Microfinance Institutions Network. They have rules to prevent borrowers getting overloaded with debt from multiple lenders.
Right. And USFB's data.
The percentage of their customers who also have loans from 4 or more other lenders has plummeted. It was 6.0% a year ago. Now it's just 1.2%.
Wow. So they've cut down exposure to those potentially overleveraged clients by, what, 5 times?
Exactly. It's concrete evidence that their underwriting is getting much tighter and more prudent. They're actively avoiding those higher risk profiles. That, to me, is a more fundamental risk mitigator than just provisions.
That's a really important structural change. Okay, so putting it all together, where do they see things going from here? Let's talk outlook and guidance.
Right. So for the rest of this financial year, FY26, they basically reiterated their previous target. Overall loan growth, advances growth around 20%. But crucially, they expect the secured book to grow much faster, around 35%.
Okay, so the diversification push continues at full speed. What about credit costs, the cost of bad loans?
They're aiming to keep credit costs between 2.3% and 2.4% of the loan book for the full year.
Hmm. Given the stress, especially maybe in H1, does hitting that target imply they expect a significant improvement in the second half? Lower provisions, fewer slippages.
It absolutely does.
Mhm.
To land in that range for the full year means they're banking on H2 being much cleaner from an asset quality perspective. They need that stabilization and the low-risk secured book growth to really kick in.
And longer term, what's the big picture vision?
Very ambitious. They're talking about hitting 1 lakh crore in advances by FY30, so roughly tripling the book in about 5 years.
1 lakh crore, wow. And how does this secured mix fit into that long-term plan?
That's key. They're aiming for the secured book to be 65% to 70% of the total by 2030.
65 to 70%, why that specific range?
Because that's the mix they believe will allow them to achieve their target profitability. They're aiming for a sustainable ROA of around 1.8% to 2.0% and ROE of 16% to 18% in the long run.
Ah, I see. So the higher secured percentage directly translates to lower risk, lower credit costs, and therefore higher, more stable returns. It's all connected.
Precisely. It's a fundamental shift in the business model they're aiming for. Moving from that high-risk, high-return, often cyclical MFI model towards something more like a diversified, stable retail bank.
And any corporate actions that underscore this shift.
Well, the big one is they applied for a universal banking license back in February 2025. That's the long-term goal.
Right, becoming a full-fledged universal bank.
And short-term, to keep feeding that CC growth, they mentioned rolling out new things like mutual fund distribution, Forex services, and eventually ASBA for IPOs. Just building out the product suite to attract and retain those low-cost deposits.
Okay, let's try and wrap this up. If you had to give the main takeaway for the listener from this deep dive.
I'd say USFB is clearly past the crisis management phase. They are executing their diversification plan very deliberately. That shift towards almost 50% secured loans now is the single most important sign that they are building a more resilient institution.
Even with those pockets of regional stress still needing work.
Yeah, those are still there, can't ignore them. But the overall strategic direction towards a more stable, diversified bank seems pretty clear, and importantly, they're actually making significant progress towards it.
It's definitely a transformation story to keep watching. All right, thanks for breaking that down. And for you, the listener, here's something to think about. We saw that achieving 65% to 70% secured loans is critical for USFB's long-term profit goals. But reaching that target means relying heavily on continued massive growth in segments like micromortgages, which grew 180% this past year. So the question is, what are the biggest operational hurdles they face in scaling these newer secured products from niche offerings to the core pillars of the bank, all while maintaining strict credit discipline? Can they grow that fast and keep the quality high? We'll leave you with that. Catch you on the next deep dive.